In this next section, we'll take a look at another way to calculate depreciation with the units of production and declining balance depreciation methods. When equipment use varies significantly from period to period, the units of production depreciation method can better match expenses with revenues. Units of production depreciation charges a different amount to expense for each period of an asset's useful life, depending on its usage. Airlines might use expected hours of flight. Miles driven by a long-haul trucker might be another usage. And another example is number of one-cup single-serve coffee packages made, or in our prior example, the number of shoes inspected on a manufacturing machine. A two-step process is used to compute units of production depreciation. We first compute depreciation per unit by subtracting the asset's salvage value from its total cost, then dividing by the number of units expected to be produced during its useful life. Units of production can be expressed in product or other units, such as hours used or miles driven. The second step, then, is to compute depreciation expense for the period by multiplying the units produced in the period by the depreciation per unit. So back to our example. The company purchased equipment that had a cost of $10,000 and an estimated salvage value of $1,000. The equipment is expected to produce 36,000 shoes during its useful life. During 2015, the equipment was used to produce 7,000 shoes. Let's follow our two-step method in calculating depreciation expense for 2015. The depreciation rate per shoe inspected is 25 cents, and 25 cents times 7,000 shoes is 1,750 in depreciation expense for 2015. Here's another depreciation schedule that nicely summarizes the units of production method. Note that the book value of the asset at the end of year 1 equals the cost of the asset less accumulated depreciation just calculated, or $10,000 minus 1,750 is 8,250. Depreciation for the second year is $2,000, that's 8,000 shoes at 25 cents per shoe. Other years are similarly computed. Notice for every year the depreciation rate is the same, it's 25 cents per shoe. The variable then is the number of shoes produced. This graphic shows that depreciation expense depends on the unit output, and the accumulated depreciation is the sum of the current and prior year's depreciation expense. And finally, the book value declines each period until it equals salvage value at the end of the asset's useful life. Note also that we don't depreciate an asset if it is idle. In our final section about depreciations, we'll take a look at accelerated depreciation with the declining balance depreciation method. An accelerated method yields higher depreciation expenses in the early years of an asset's life and lower depreciation in later years. The IRS permits the use of accelerated depreciation methods under the Modified Accelerated Cost Recovery System, MACRS, in other words. By taking more depreciation expense sooner, companies reduce net income, pay lower taxes, and have more cash available for investment in the economy. For financial accounting purposes, the most common accelerated method is the double declining balance method of depreciation, which uses a depreciation rate that is 2 times the straight line rate and applies it to the asset's beginning of the period book value. The amount of depreciation declines each period because book value declines each period. To determine the double declining balance depreciation rate, divide 200% by the asset's useful life in periods. To calculate depreciation expense, multiply the depreciation rate times the asset's beginning of the period book value. Now, unlike other methods, this method ignores salvage value, and this creates a potential problem. We must remember to stop depreciating the asset in the period when its book value is equal to the salvage value. We usually force the depreciation expense in the final period to meet this objective. To illustrate, let's apply the double declining balance method to compute depreciation expense for our $10,000 machine with a 5-year useful life. Can you determine the rate in depreciation for the first 2 years? Pause the video for a moment and try it out. The process to compute depreciation is to, number one, divide 200% by 5 years to get the declining balance rate of 40% or 2/5 per year. So secondly, what we need to do is compute depreciation as 40% or 2/5 multiplied by the beginning of period book value. Depreciation expense for the first year is our $10,000 cost times 40% or $4,000. And the book value of $6,000 then at the beginning of year 2 is equal to the original cost of $10,000 minus accumulated depreciation to date of $4,000. And $6,000 times 40% equals $2,400 depreciation expense for the second year. The double declining balance depreciation schedule shows that the formula we learned works well, except for the last year of the asset's life in the year 2019, when depreciation expense is $296. This $296 is not equal to 40% times the beginning book value of $1,296 or 518.40. Okay, if we had used this $518.40 for depreciation expense in 2019, the ending book value would equal $777.60, which is less than the $1,000 salvage value. That would be a problem, right? Instead, the $296 is computed by subtracting the $1,000 salvage value from the $1,296 book value at the beginning of the 5th year, the year when the double declining balance depreciation cuts into the salvage value. While depreciation expense per period differs for each of the different methods we learned about, total depreciation expense of $9,000 is the same over the machine's useful life. The book value of the asset when using straight line is always greater than the book value from using the double declining balance, except at the beginning and the end of the asset's useful life when it is the same. Also, when the straight line method yields the same amount of depreciation expense every period, but the units of production depreciation depends on the number of units produced. Compared to the other methods, the double declining balance method results in significantly more depreciation early in an asset's life and significantly less depreciation late in an asset's life. Each of these methods is acceptable because it allocates cost in a systematic and rational manner. Approximately 85% of companies use straight-line depreciation for plant assets because it's easiest to implement and understand. If you'd like to practice the methods we've just covered, I've posted this exercise in the solutions on Dean 2L. And as some of you remember, Theodore is my best little friend. See you in a bit.